The program focuses on how investors access alternative investments through private structures and the unique characteristics associated with these arrangements. Private investment structures differ significantly from listed investment vehicles in terms of liquidity, governance, transparency, valuation, and investor rights. While listed investments provide daily pricing and easier transferability, private structures often require long-term capital commitments and involve limited liquidity. Investors typically access private equity, private real estate, hedge funds, and infrastructure assets through limited partnerships or similar private arrangements. These structures are designed to align the interests of managers and investors while allowing managers greater flexibility in executing investment strategies that may not be feasible within publicly traded investment vehicles. Private and listed investment access methods each offer distinct advantages and disadvantages that investors must evaluate carefully. Listed structures provide transparency, lower minimum investments, and immediate liquidity through public markets. However, listed vehicles may be more sensitive to short-term market sentiment and public market volatility. In contrast, private investment structures often offer access to specialized opportunities, illiquidity premiums, and active value creation strategies unavailable in public markets. Private structures may also reduce short-term pricing volatility because valuations are updated less frequently. Nevertheless, investors in private funds face reduced liquidity, less transparency, higher fees, and longer holding periods. The program emphasizes that choosing between private and listed access depends on investor objectives, liquidity requirements, risk tolerance, and investment horizon. Manager-investor relationships within unlisted investment structures are central to successful alternative investment programs. Most private funds operate through limited partnership arrangements, where the general partner manages investments on behalf of limited partner investors. These relationships require strong alignment of interests because investors commit capital for long periods with limited control over daily operations. Due diligence, therefore, becomes critically important when selecting private fund managers. Investors evaluate manager experience, governance standards, investment processes, operational controls, and historical performance before committing capital. Ongoing communication and transparency between managers and investors are also essential because private investments lack the continuous market pricing available in listed securities. Trust and reputation play particularly important roles within long-term private investment relationships. Side letters are negotiated agreements between fund managers and certain investors that modify or supplement the standard partnership agreement. These agreements often grant preferential terms to large or strategically important investors. Side letters may address issues such as reduced management fees, enhanced reporting requirements, liquidity rights, co-investment opportunities, or most favored nation provisions. While side letters can help attract institutional capital and accommodate investor-specific requirements, they may also create concerns regarding fairness and unequal treatment among investors. The program highlights that side letters can increase operational complexity and potentially introduce governance challenges within private funds. Investors therefore need to understand both the benefits and risks associated with negotiated contractual arrangements beyond standard fund documentation. Cash commitments and illiquidity are defining characteristics of private investment structures. Investors in private equity and similar alternative funds typically commit capital upfront, but contribute cash gradually through capital calls as investment opportunities arise. This commitment structure creates commitment risk because investors must maintain sufficient liquidity to meet future funding obligations. At the same time, distributions from investments may occur unpredictably over extended periods. Illiquidity risk is significant because investors often cannot redeem their interests before the fund's termination. The program explains that illiquidity may generate higher expected returns through illiquidity premiums, but investors must carefully manage cash flow planning, portfolio liquidity, and allocation pacing to avoid funding shortfalls during adverse market environments. Secondary markets for private equity partnerships have developed to address some of the liquidity limitations associated with private investment structures. In these markets, investors may buy or sell existing partnership interests before fund maturity. Secondary transactions can provide liquidity to investors seeking early exits, while allowing buyers to access seasoned portfolios with more predictable cash flow profiles. Secondary market pricing depends on factors such as portfolio quality, remaining fund life, market conditions, and expected future distributions. Discounts to net asset value are common during periods of financial stress or market uncertainty. The growth of secondary markets has improved flexibility and efficiency within private capital investing. Although transactions remain complex and require extensive due diligence regarding underlying assets, fund structures, and manager capabilities.